welcome to the Global View. It is September the 21st. We're going to look for some ways to make money beyond the ASX. And for the first time, I think ever, we're taking a trip to Central Europe. First, though, I'd like to get you across the Fed. So policy rates unchanged between 5.25 and 5.5%. It's projecting one more rate hike this year. But
real interest rates now are well above mainstream estimates of the neutral policy rate. But we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
But what sent a chill up the spine of stock market investors is the dot plot. So looking ahead, they show rates only falling by half a percentage point in 2024 compared to the full percentage point of cuts that was anticipated at the meeting in June. So the FOMC statement made clear inflation remains elevated, and that is still the main game, but its forward projections now incorporate stronger economic and jobs growth than its prior forecasts. So after expecting growth as weak as 0.4% for this year, the Fed now sees the economy growing 2.1% in 2023. So it does have the soft landing scenario squarely in view, and that's how the rates compare to other key developed markets. Bond yields moved higher in the face of the higher for longer monetary policy stance, the 10-year ending at 4.4%, 2-year rising to its highest since July 2006. The dollar erased its losses to trade up on the day against a basket of major currencies. Elsewhere, UK inflation came in lower than expected. The Bank of England is expected to lift rates by 25 basis points tonight. Well, dividends. We often think of Australia as being a very dividend-heavy market, and it is, but is it on a long-term basis? I had a really interesting conversation earlier this morning with Jonathan Nurik from DivGrow. So he is talking about investors almost universally underperform because they make mistakes. Let's listen into what he says about the hunt for dividends and why they're so important when it comes to long-term investing.
Relatively few companies that meet our criteria, which is consistent, reliable, dependable, no exceptions dividend growth, meaning a company can continue to pay and raise its dividend rain or shine, whether you had COVID, an inflation, a change in interest rate, continue to pay and raise that dividend. So there aren't many. And we have turned an ability into this art and science of trying to find them.
Okay, I have to have a healthy dose of skepticism when you say art and science. Like, what is that?
It's a combination of quantitative factors, a margin profile, a dependability on some other factor that a company can't control, whether that's an oil price or a coal price. We don't own companies in the resource space, as an example.
So we'll rule out all the odds.
So we'll rule out
even
things
when they're paying great dividends.
That's right. A lot of people think of the resource companies as great dividend payers, and sometimes that's true. When the iron ore price goes up very quickly, they all make lots of money, and as a result, they pay very significant dividends. But these companies individually can't control the iron ore price, and as a result, when the iron ore price subsequently declines, as sometimes it does, their dividends quickly get cut. And when the dividend gets cut, the share price tends to follow. And if we contrast that with things that have what we consider an installed base, they know what their sales will be like next year and the year after that with a very high degree of predictability, because they are selling parts, spares, cartridges to the same company that needs it to open its doors every day.
I find that really interesting because oftentimes we think about Australia as being a dividend-rich country. In fact, we've criticized our companies sometimes for not holding on to more of their income to, help develop their businesses for the future. So are you saying that Australia is not an attractive place for income-driven investors?
It's not that it's not attractive. In every market, you find a few players, a few companies that are a little bit what we might call special. But what you find in Australia, and this is a combination of who the investor base is, large super funds control a lot of the market, the fact that we have franking credits, which changes the dynamic a little bit. Payout ratios in Australia for more mature companies tend to be very high. And as a result, they reinvest much less. And it's harder for them to expand the business, and you need to expand the business to be able to earn more, to pay higher dividends. If we contrast that, say, in the United States, where at least where we look in some of our industries, payout ratios are much lower. Instead of 70, 80, 90%, they're more like 10, 20, 30%. So a small part of the earnings come out as a dividend. The majority gets reinvested into what we hope is a great business. And that enables next year's dividend to rise, and to rise again the following year. And this only works, or tends to only work, in very predictable industries that do not depend on a price to dictate their profitability. So unlike, say, the iron ore or the oil price, we look for things that are installed bases of software, of medical devices, of fast food franchises, of critical business services that a company can't begin its day without getting that supply.
So as well, your strategy then is not sort of dividend harvesting. So what is your investment time frame, generally speaking?
Ideally, it's forever. To quote Warren Buffett, our preferred time frame is forever. And one to give you an example, some of the companies that we own have been able to grow their dividends every single year, no exceptions, for decade after decade after decade at double-digit rates. And as long as that continues to be true, and we believe that can continue, and this is where it's part art and part science, some quantitative, some qualitative factors, we're able to try and forecast where this dividend is going to go. And if we're satisfied that we believe with a high degree of conviction that the dividend will rise at a double-digit rate, we'll continue to own. Now, not every company can do that forever. Sometimes they simply exhaust their ability to grow into a market. And unfortunately, at that point in time, our drivers, our areas of research begin to indicate this company's dividend is likely to slow down. If the dividend begins to slow down, the rate of change in the price is likely to slow down as well, and we simply let it go and move on to something else.
Look, I've got to come clean with you. That's not the whole interview. We will play that interview out later in the day in full, or you can catch up online later on at ausbiz.com.au. And Jonathan names the perfect income stock in his view. It's in the US. You'll want to watch it for the rest. Meantime, let's go to Central Europe. We've got lots happening there. Europe's biggest economy, Germany, facing recessionary headwinds. But what about economies in Europe that are often considered emerging markets? Countries in Central Europe like Poland, the Czech Republic, and Hungary. Well, I had the chance to speak with Arthur Budagayan from BCA Research a little bit earlier on, who talked to us about Central European investment opportunities.
If we look at Central European economies, they are basically overheating in terms of domestic demand. Wages are very strong in Poland, in Hungary, even in Czech Republic. And a Polish central bank went ahead and cut interest rate when wages rising at double-digit rate. We believe it's a policy mistake, and it gave opportunity to short Polish zloty. We believe Polish zloty is very vulnerable because interest rate cuts when wages are rising at double-digit rate and inflation is very elevated is the wrong policy. It's negative for exchange rate.
Okay, so what you're saying is that we could see some of these Central European countries entering a recession officially?
I think they're already negatively affected by European growth prospects. But central bank cutting interest rate during inflation is going to be negative for other financial markets, exchange rate and a bond market, even though it might not be negative for the economic growth. We recommend investors avoiding Polish stocks, Polish bonds, and Polish currency, even if GDP growth is going to be okay.
So you are shorting the Polish currency versus the US dollar. Are there any better prospects in Central Europe?
I think in Central Europe, the best macroeconomic backdrop is in Czech Republic. So if we have to choose one currency or one bond market or equity market to be long, it will be Czech Republic. Among three countries, Polish, Hungary, and Czech, we favor Czech at the moment.
So when you are thinking about equity exposure in Central Europe, again, how do you favor some countries over others? Where would that be?
Typically, the main driver of local markets is a bond market. Rising bond yields are typically negative, and falling currency is typically negative for equity returns, especially for foreigners. Given we are bearish on Polish zloty and Polish bonds, we cannot be bullish on Polish stocks, and we're positive on Czech krona, Czech bonds on relative basis. That's why we favor Polish Czech stocks versus Polish equities. Hungary falls somewhere in between. Still will be favoring Czech market more than Hungarian, and we would basically be underweight Poland versus Hungary too.
Arthur, just to educate me and forgive my ignorance, what are the main components of Czech equities? What are the big sectors there?
I think it's very narrow market. It's a small market. Banks are major component, telecom, utilities, and that's a kind of the main sectors.
Okay, and so when do you see the risks abating for Central Europe? Obviously, it's a very troubled part of the world when you consider Ukraine and Russia and some of the energy price pressures that are likely to come through in the winter. How do you view the following year, so 2024, and how it will evolve for some of these Central European economies?
All of these economies are very leveraged to core Europe. To be bullish on Central Europe, we have to be bullish on core Europe. And I believe core Europe is heading into recession. Probably recession will last till mid of next year. And towards the mid of next year, there will be better opportunity to start bottom fishing in Central European markets. And again, countries that pursue more orthodox, prudent macroeconomic policies like Czech Republic will be high on our buy list versus Poland and Hungary that are pursuing less orthodox, less prudent monetary and fiscal policies.
Okay, let's just, before we go, check in on a tweet that came across. Well, there's SPY futures, expecting to see them down by about 20 points or 0.27% at the open. And here is a tweet. So this is Ryan Detrick. He's pretty bullish on the market so far. So he's saying that years that were up 10% at the midpoint tended to consolidate for several months right around now. So what he's saying, this period of consolidation that we're in August, September for U.S. markets is perfectly normal. He is expecting new highs in the fourth quarter, which goes along with what one of my guests earlier this morning was saying, Ira Epstein from Linen Associates. He reckons, be cautious right now, keep your cash ready for opportunities that will come later toward the end of 2023. Stay with us. We'll get you across the open in just a tick.